Big news. Recently, the Fed cut its base rate by 0.5%. And I know there's been a lot of confusion about what that means for mortgage rates, so let's clear things up. I'm Ligaya, and here's a breakdown on how the Fed rate cuts affect you and mortgage rates. First off, although Fed rate cuts affect home equity line of credits, credit cards, adjustable rate mortgages, and car loans, it doesn't mean that mortgage rates were automatically impacted. There's a lot of misinformation out there, but the truth is that mortgage rates move independently, even though the Fed rate cuts do have some type of influence on them. As of this morning, mortgage rates were actually trending downward. But it's important to remember they aren't directly tied to the Fed's decision. We should know more in the coming days and week on what's to come. But if you are thinking about refinancing or buying a home in the near future, then here are three key signs to keep your eye on. Number one, more buyer activity. So if we start seeing more buyers entering into the market, that's a good indicator that rates might be dropping. And when rates drop and they become more attractive, then buyers typically like to buy in because they want to take advantage of lower borrowing costs. So if homes start selling faster and there's more bidding wars, that's a strong sign that rates could be falling. When consumer confidence rises due to lower rates, buyers don't want to miss out on locking in a good deal, which creates more housing activity in the market. The caveat is how that impacts housing prices. Point number two to look out for is an increase in refinancing. Another big sign is when you see more homeowners refinancing their existing loans. So refinancing becomes really appealing when rates are lower because current homeowners can secure a lower interest rate to save them money on their current monthly payments. If you notice that lenders start to promote refinancing deal or you start hearing people talking about refinancing, that's an indication that rates are moving in a favorable direction. Homeowners won't refinance unless they know it's going to save them money, so a surge in refinancing applications is a signal that rates are lower than they've been in the past. And the third indicator is positive economic news. So economic indicators play a big role in mortgage rates. If we see a strong job growth, increase in consumer spending, and an overall boost in the economy, lenders tend to offer better mortgage rates. A strong economy often leads to more stability and the lower risk for lenders, which in turn leads to more competitive interest rates. So if the economy is showing signs of strength, that's an indicator that mortgage rates might start to drop and more favorable terms could be on the horizon. So while the Fed's rate cuts can influence mortgage rates, it doesn't directly set them. If you're seeing more buyers, a rise in refinancing, positive economic news, then mortgage rates may be dropping. And if you have questions about how this might impact your future home buying purchase or your ability to refinance, then send me a message or leave me a comment below and I'll help you out. Thanks for watching. I hope you found this helpful, and don't forget to give me a like and subscribe.